And so I don't know, maybe you're pretty good at this macro thing. And so if that was your prediction last summer, which has since more or less come to pass, what are you predicting now?
Um, the inflation was actually a little higher than I thought it would be, although I thought it was going to be above 6%, which at this time seemed quite radical. Um, B, the bubble has really burst with a vengeance, a lot more than you can see in the S&P. A lot of very good companies have been derated 60, 70% without a whole lot of change in fundamentals. So valuations have improved relative they were. And then C, I'd say the biggest surprise since I talked last spring was how slow the Fed was to recognize the problem. I thought they were slow not recognizing it last in April of 21, but they were still buying bonds in March of 22, and they were still not even pivoting verbally until November. I think that period was incredibly costly because a lot of assets, a lot of assets were purchased during that period that I think a lot of people moving out the risk curve will lose a lot of money on. I would just say, where are we now? It's hard to believe, given the extent of the monetary policy the last 10 or 11 years. I think globally we had 30 trillion of QE. Um, Even as late as I think a year ago, there was 18 trillion of debt that was still negative yielding when the world was about to experience 8% inflation. It's pretty extraordinary. So it's hard for me to believe you could have unwound all that created in terms of a misallocation of resources in 6 months. So my best guess, and this business is about guessing, there are no certainties, is that we're 6 months into a bear market that has some room to run. For those tactically trading, it's possible the first leg of that has ended, um, but I think it's highly, highly probable that the bear market has a ways to run.
Is it going to be a soft landing or a hard landing?
Well, the answer is I don't know, but the probabilities of it being a soft landing are pretty remote, John. Um, Historically, I think we've only pulled off two or three in history. The one I lived through and remember so well was the 94, 95 one, but we've never had a soft landing after inflation's gotten above 4.5%. And the situation we face now is extraordinary, where the Fed, where are we these days? I guess we're at 75 basis points. I can't keep up. But even the projections of 2%, you're so far behind the inflation rate, and there's so much wood to chop, and there's been such a broad asset bubble going into it. It's very hard for me to say that the probabilities favor a soft landing. Indeed, I think they aggressively point to a hard landing. Anything's possible. As I said earlier, I've been wrong plenty of times in my career, but betting on a soft landing to me is a real long shot.
So you think once inflation goes above 5%, it's very hard to tame it in a way that's elegant.
Well, that's what history says. There's an interesting historical fact, which in fact I think is going to be violated, but two undefeated records are: number one, once inflation gets above 5%, it's never come down unless Fed funds have gotten above the CPI. Well, since the CPI is 8, that would call for a Fed funds rate of above 8. Frankly, I don't think we'll get there because the extent of the asset bubble and the damage that would be done. But if you look across the landscape, there should have been many, many, many bankruptcies which have been buried by QE. So if in fact Fed funds ever got to 8%, which by the way, I don't think is going to happen, um, the destruction would be quite material. The other statistical fact is once inflation's got above 5%, to use your word, it's never been tamed without a recession. So if you're predicting a soft landing, you're going against decades of history. Could happen, anything's possible, but I don't think it's probable.
No, I think those historical examples are quite sobering. Was it you said that once inflation goes above 5%, it has never come back down without the Fed funds rate going above the CPI?
Yes, and the
Yeah,
CPI is currently 8 year over year. Um, I actually think we are going to violate history and it is going to come down. I don't know how far, but without that happening, the second one, I think history is going to win. That's once inflation gets above 5%. It's never come down without a recession, and I think a recession is in the cards. I just don't know when. We have about, depending on who you listen to, $1.5 trillion to $2 trillion of excess savings now. So it may take some time to work through that savings, but given the extent of the asset bubble and the destruction in the markets, given what's going on in Ukraine, given zero COVID policy in China, I don't take a lot of comfort from that. So I assume, and I pretty strongly assume, we're going to have a recession sometime in 23. I just don't know whether it's going to be in the early part or the later part. And again, it's a guess, it's not a fact.
As we talk about what's going on in the market, or sorry, in the economy and not the market, one thing I find really interesting about your style is people like to trot out the phrase, the stock market is not the economy, but you have, been on the record a number of times talking about how you use the stock market as a signal for what's going on in the market, in the economy. And so, you have this distributed team. If you look at all the, stock analysts out there covering all these different stocks and all these different sectors, they're kind of like the, engineer in the cockpit of the train. And, when the, dial starts flashing and, it's a sign that you can investigate more. So I'd love you to talk about this approach where you are using movements in stock prices to decide or to know that, something's going on there. Maybe I should go investigate.
Yeah, one of the ironies of my style is that I don't use what traditional economists use to predict the economy, which is things like employment and a bunch of macro top-down statistics. In fact, I started my career as a bank and a chemical analyst, and over time I learned that the inside of the stock market had a very, very prescient message about future economic activity. And for whatever reason, stocks tend to lead the fundamentals by somewhere between 6 and 12 months. And you can even go beyond that and look at industries that lead the economy and industries that lag the economy. The obvious one that everyone knows about is housing, has traditionally been looked at as a leading industry. Retail has a slight lead, capital goods lag. And what we've done historically is actually, even though you referred to me as a macro investor and many people have, is we do the macro by a compilation of listening to companies and doing a bottoms up analysis. And if the leading industries are turning up or turning down, that's a signal. And that's worked beautifully historically. The other signal, which I have found quite prescient for markets, is the bond market. Unfortunately, the last 10 or 11 years, the bond market has not signaled anything because the central banks took it upon themselves to manipulate bond prices, which to me is the 10-year treasury has sort of been the most important price in the world. And they took that price out of the equation as a signaler. I remember last summer when certain forecasters had a different forecast than my own, kept talking about, well, the bond market is saying this, the bond market is saying that, when the 10-year dropped all the way from 170 to 115, which, by the way, I did not anticipate. But the bond market wasn't saying anything. What was going on is central banks were buying trillions of dollars and manipulating the price of bonds, so there was no signal. I don't think you get that tainting if you look inside the stock market. You could get it in the stock market as a whole, but if you do this approach where you look at industries and which lead, which lag, and you put the puzzle together, it's been prescient over time, and it's certainly allowed us to consistently the last 20 or 30 years outperform the Fed in terms of economic forecasts.
I find that really interesting. Equities acting as kind of this synthesized predictors for certain industries. And so, say if you think about understanding what's going on in housing, again, the economy now, what kind of concretely, what will you be looking at? Is it publicly traded REITs? Is it the stocks of construction companies? What does that process look like for you?
Well, there's you don't need to get real fancy here. You can just do the home builders themselves. And with supposed good fundamentals, they've all declined 50% from the high. Another industry that's been incredibly prescient has been trucking. Um, and they're down 40% from the high, despite the fact that they're all reporting record earnings. Um, an industry that is not that much of a leader, but it's more of a leader than a laggard, is the retail industry. And there's been a lot in the news lately, whether it's Walmart or other companies, retail. That one's a little tainted. You just can't take these things blindly, John. That one's a little tainted now because in COVID, retail went to 100% of the wallet from about 85% because we weren't going outside and traveling and going to football games. But even taking that into account, retail appears to be much weaker than it should be given what the so-called GDP numbers are printing. So right now there's a signal, albeit early, that there may be trouble ahead.
Yeah, so you look at trucking stocks being down 50%, and you say, okay, this probably does not bode well for trucking volumes. It kind of has to be the case.
Yeah, and if it was just trucks, fine, but it's not just trucks. It's housing, it's retail, it's all over
Yeah,
the place. And by the way, you
yeah,
can't get too carried away and say that means we're going to have a recession tomorrow morning. A lot of these things have longer lead times, like 6 months to a year.
yes. One thing you're also getting at here, kind of when you reference that you used to be able to look at the bond market and kind of now you can't, is it seems very true that the investors who perform really well over multiple decades have to shift stylistically over time and become new kinds of investors. I kind of love the stories of the value investors back in the day, where if you look at what Ben Graham was actually doing, you're hunting for companies where the book value is greater than the market cap of the company. There's a famous case of Northern Pipeline where they were trading at $65 a share, and they just had $95 a share of stuff and railroad bonds or whatever on their balance sheet, and he bought a bunch of their stock and then just yelled at them and complained until they finally dividended out $95 a share of their assets. But that doesn't work anymore, obviously. Markets have gotten a lot more efficient, and you can't just buy companies that own more assets than their market cap. So value investing has to change. And similarly, you're describing here, especially the relationships with bonds, relationships with currencies have to change. And so I'm curious, can you talk a bit more about how you stylistically have had to change the tools in your toolkit?
That's really an excellent question, and it's right on point because when I got in the business, um, you could almost guarantee if a company reported lousy earnings, opened down that day and closed up big, that stock market was going to be higher 6 months from then, and vice versa. You could almost always guarantee if the economy looked great and bonds were rallying, that meant the economy was not going to look so great. We used to call it price action versus news. And it used to be an incredible indicator of security prices, partly because of the efficiency, partly because I think the growth of hedge funds, we all learned these rules, and partly because of central bank manipulation. Price versus news is a very weakened tool versus 20 years ago, much to my chagrin, because I always found it a great warning signal. And now, a lot of times, it may be warning of nothing or warning of something that doesn't exist. So that's been one thing I've had to adopt to. I mean, frankly, when I started in the business, I'm showing my age here, which was the mid 70s, I started in equities. And I also learned, particularly in bear markets, that I had to morph into bonds, into commodities, into foreign currencies, things like that. I've always made even higher returns in bear markets than bull markets. But the way I did it was just pretty much ignore equities, take them off the table, buy bonds, buy treasuries, and go home. Well, I've never been presented a cocktail where you have 8% inflation, you think the economy might weaken, and bond yields 3%. It's an analog with no precedent in history. So you can't get into black and white, that it's an art form investing in from cycle to cycle. You have to constantly innovate and not just be a slave to past models.
So how are you positioning the fund given that, maybe you don't feel so good about going long equities, but your normal bond toolkit is not working quite well? Is the golf thing top of mind because, it's actually hard to, to do too much? Or how are you positioning things?
Well, currently I'm very challenged. We were lucky enough to have made some money up until now, the last 6 or 8 months, primarily by having let me call it a matrix of short fixed income, short stocks, and not doing a whole lot in currencies and owning some of the key commodities, particularly oil and mistakenly gold, but copper. Um, Things are a lot harder now because we're now getting definitive signals that the economy may be weakening, particularly at the front end. And while I'm not comfortable owning bonds, I'm much less comfortable being short fixed income to the degree I was 3 to 6 months ago when it looked like a much better risk reward. And even stocks, so many companies have been derated by 60 or 70%. And I've lived through enough bear markets that if you get aggressive in a bear market on the short side, you can get your head ripped off in rallies. So currently I'm coming in every day and I'm looking at my screen, but I'm pretty much taking a break. I'm waiting for a fat pitch. I'm not shooting at any pins, to use a golfing analogy. My anticipation is I will be going back to the short equity position at some point if the market affords me. If not, hopefully I'll just sidestep a decline. That's not the worst thing in the world. But the fixed income market has become much more complicated. And I'm lucky enough, since I play in a lot of asset classes, to have the luxury of not playing in one. And I don't think I'm going to be playing much in that one going forward. The currency market is incredibly interesting to me. I haven't been doing much there, and I'm not currently positioned aggressively there. But I will be surprised if sometime in the next 6 months I'm not short the dollar. $14 trillion has come in here because we were the first to tighten. There's a story about American exceptionalism. I'm not sure we're so exceptional anymore, and if we are, I'm not sure I'm excited about what we're exceptional in. So foreign exchange looks interesting. We still own energy and other commodities. Ukraine sort of gave that trade an extended life, although I must say the energy, because of the transition to ESG, we look to be short energy for 5 or 10 years, so that could last a while.
It's so interesting to hear you talk about this stuff because you so fluidly move between all these different asset classes. And one thing that makes me think of is crypto. Obviously, you've done kind of a little bit in crypto before. I remember you saying that it's just hard to get the size of position that is interesting to you in crypto. One thing I was wondering, are you seeing crypto start to affect other asset classes and other currencies?
I don't know whether I'm seeing it, but I expect it to. You can't build over 2 trillion in wealth in purchasing power and then take 1 trillion of it out and not matter. John, I also have high frequency signals, and there certainly seems to be a strong correlation between crypto and the NASDAQ. I don't think it takes a genius to figure out why. So I'm looking at it as an indicator that way. Crypto, everything that Charlie Munger says about it, I'm sympathetic to. Everything that says Bill Miller says about it, I'm sympathetic to. So I think that's a movie that has yet to be played out and one that I don't want to bet on in conviction, but I will be very surprised if blockchain isn't a real force in our economy, say 5 years from now to 10 years from now, and not a major disruptor with companies that will have been founded between now and then that'll do very well, but that will also challenge things like our financial companies and do a lot of disruption. So I find crypto interesting. My 69th birthday is in a couple of weeks. I'm probably too old to compete intellectually with the young people in this space, but I'm certainly monitoring it.
I was going to ask that. Do you think younger Stan would be kind of diving into crypto more energetically?
I think a younger Stan would be diving into everything more energetically than I'm talking to. It's age is a funny thing. I don't. I feel my predictive power and forecasting power is as good as it's ever been the last 3 to 5 years. But I'm certainly not making 30% net returns per year like when I had clients. So I think it's two things. Yes, I think younger people understand new asset classes better. But B, I'm just not playing anything as aggressively as I used to.
I want to get back to that because that's interesting. But one other crypto related question, as I think about um, Bitcoin, the closest analog is clearly gold, and people talk about digital gold. By which I mean, if you want to remove yourself from cash, if you want to be independent from inflation, your government in whichever country you're in, traditionally gold would be the asset that you would kind of pull back into. Nowadays, that can be Bitcoin, and so you'd expect their cyclicality to be similar. And yet, Bitcoin is highly cyclical. Gold is counter-cyclical historically. Why is that?
I'm not sure why, other than NASDAQ type risk play takers are the ones that tend to play in Bitcoin and curmudgeons that are gold bugs and want the world to fall apart play in gold. But there's no question, and this I've watched and it's gone on long enough now that I believe it, that if you believe we're going to have irresponsible monetary policy and inflation going forward, if it's in a bull phase, you want to own Bitcoin. But if it's in a bear phase for other assets, you want to own gold. And for sure, if I think we're going to have an inflationary bull market, I'd want to own Bitcoin more than gold. And if I thought we're going to have a bear market, stagflation type thing, I'd want to own gold. Doesn't mean I'm going to believe that in a year, but that's my assumption going forward from this point.
And is that because of some fundamentals of the underlying assets, or just based on what you've observed in their behaviors to date?
It's 85% what I've observed, but I would also say it's the type of investor.
Yes. Going back to how you work and kind of the young man's game and things like that, I talked to someone who worked for you who said maybe an underrated aspect of your performance historically is you just work way harder than everyone else, and there's few people who have been in the market since the 70s working with your work ethic and across such a broad range of assets. How relevant do you think that is, or how much truth do you ascribe to that?
I think it's very relevant. I was pretty lazy in college and I never considered myself a particularly hard worker, but I'm so passionate about our business that it's almost like a compulsive gambler that has a way to channel his compulse. And the fact that every event in the world affects some security price somewhere, and the fact that I'm so intellectually stimulated trying to imagine the world 12 to 18 months from now versus the way it looks in the present, and security prices, how they would reflect that. I just find it so stimulating. It makes everybody think I'm a hard worker because I'm attracted to the game. So in this game, I am a hard worker, but I actually think there's a life lesson there. I've seen young people who, when they find their passion, who had kind of looked like they were lazy or lost their way or weren't very driven, become very driven. I just happen to be passionate about this particular discipline. So I don't know whether I have a hard work ethic, but that's the end result of my passion.
Yeah, and certainly we may see an interesting scenario play out over the next year or two. Um, Going back to your style, the other thing I found very interesting in how you work is this, your philosophy of put all your eggs in one basket and then watch this basket very carefully. And you've described how you just develop conviction 3 to 4 times a year and act based on that. And I'm curious if you could talk a little bit more about that, like the spidey sense going off, and you're clearly in a low conviction time right now. But I think that's just very stylistically interesting, where you even know how to size up and down your trades.
Yeah, it's completely contrary to what they teach in business school, which is if you're highly diversified, you have less risk than if you're highly concentrated. Um, I don't believe that at all. As an investor, when I think most people get in the most trouble is when they have stale longs or stale shorts. Um, Believe me, they're not getting stale, and you have to have ruthless discipline, and you're coming in every day. Just to quote Andy Grove, you could not be more paranoid, and you're constantly reevaluating, and I think it leads to an open mind. So, yeah, I would also say people ask me what I learned from George Soros. I thought when I went there I was going to learn what made the yen and the Deutschmark go up and down and that kind of thing. No, what I learned was um, sizing is probably 70 to 80% of the equation. It's not whether you're right or wrong, it's how much you make when you're right and how much you lose when you're wrong. I've also found as an investor, I believe in streaks. You see it in baseball, you see it in everything else. I see it in investing. Sometimes you're seeing the ball, sometimes you're not. One of my number one jobs is to know whether I'm hot or cold. And when I'm hot, I'm supposed to turn the dial way up, not say, okay, I'm up 40% this year. Let's go. This will look good at the end of the year. Go take a break. No, you got to make hay while you're hot. And then when you're cold, the last thing you should do is try and make big bets to get back to even. You should tone yourself down. So believe it or not, that's part of the all your eggs in one basket. Not only do I have to see the investment that really excites me, I also have to see myself sort of being in a good trading rhythm.
I think this is so interesting, this notion of, first off, having hot and cold streaks. Because do you know when other people are hot, by the way? So people at the firm now at Duquesne, do you know when to egg them on to size up their positions? Because you can tell they have it together.
I size up their views, and the answer is yes. I see guys within my own firm, analysts who recommend things, and they go on streaks too, or they get an area and they're really hot. And my job as a trigger puller is to size them up.
The other thing I find so interesting about this dynamic in terms of working with your team is the invest then investigate idea. And I remember talking to someone else who works at Duquesne who described the terrifying feeling of having joined and telling you about an idea before lunch, and then they go out to lunch and they come back and they find that you've put on a massive position based on this just idea that they thought they were telling you and you're actually trading on. And so can you talk a bit more about kind of why that matters, why it makes sense from an EV perspective and kind of any stocks where it worked particularly well?
Well, you mentioned earlier that the business has gotten a lot more competitive than it was 20 or 30 years ago. There is so much information out there, and so many smart people in our industry have come in since 2000 when the financial remuneration went crazy, that you just don't have the time you had when I got in the business. When you hear a good idea, if you wait 2 or 3 weeks, a lot of times now, believe it or not, 60 or 70% of the move will have taken place. Maybe not the long-term move, but entry price is important, and it's important psychologically as you add over time. So yes, look, if some analyst comes in with a great idea or an idea, I don't just buy it and then go tell them to do the analysis. But if they have an idea that appeals to me intuitively and I really like it, and it might fit in with the macro matrix we described earlier, It might tick a bunch of boxes,